Venture capital is one of the most influential forces shaping the modern startup ecosystem. It's the fuel behind many of the world's most disruptive companies, from Airbnb to Coinbase, from Uber to Stripe. But for founders, understanding venture capital is not just about knowing where money comes from, it's about understanding the rules of the game, the motivations of investors, and the mechanics that determine whether you succeed in raising capital or struggle to survive. Venture capital is not charity. It's a structured system designed to take big risks in exchange for potentially massive rewards. By learning how it works, founders gain the insight needed to raise money strategically, negotiate effectively, and build lasting companies. Venture capital matters for four big reasons. The first is that it acts as a startup growth engine. Without VC funding, many of the most transformative startups would never have scaled. Capital provides the resources to hire talent, build technology, and expand globally at a pace bootstrapping alone cannot achieve. The second is that VC offers value beyond capital. A top tier VC brings more than money, they bring connections, credibility, and strategic expertise. Their networks open doors to partnerships, customers, and future investors. Their reputations add legitimacy that startups can rarely earn on their own. The third is that VC has become the unicorn factory. If you scan the global list of billion-dollar startups, the vast majority are venture backed. VCs specialize in identifying companies with exponential growth potential and supporting them until they dominate industries. The fourth is fundraising success. If you want to raise significant capital, especially for a high growth startup, you need to understand VC mechanics. Without that knowledge, you risk entering conversations unprepared, misaligned, and at a disadvantage. In short, venture capital matters because it's not just money, it's acceleration, credibility, and the pathway to building world changing companies. At its core, venture capital is a type of high risk, high reward investment. VCs fund startups that traditional banks and lenders won't touch, companies with unproven models but massive growth potential. VC firms raise their money from limited partners, pension funds, university endowments, wealthy individuals, and other institutional investors. These limited partners entrust capital to the VC, who pools it into a fund. The VC fund then invests in startups in exchange for equity ownership. Unlike loans, which are repaid with interest, VC is a bet on ownership. If the company succeeds, the VC shares in the upside. If it fails, the VC loses the investment. The goal is always exit driven returns. VCs are not interested in modest profits. They want transformative outcomes through IPOs or strategic acquisitions. Their business model depends on a few outsized wins that return many times the original investment. The key insight is that VCs are intermediaries. They don't invest their own money at scale. They manage capital from institutions and wealthy individuals, channeling it into startups that have the potential to reshape industries. To understand venture capital, you must understand the structure of VC firms themselves. VC funds are organized around a fund lifecycle, typically lasting 7 to 10 years. This gives companies time to grow, reach milestones, and exit. Early years focus on investing, later years on managing portfolios and harvesting returns. At the top are the general partners, GPs. They source deals, perform due diligence, and make final investment decisions. Their expertise, networks, and judgment determine the fund's success. Providing the capital are the limited partners, LPs. These are the pension funds, universities, family offices, and institutions who contribute money but play no role in day to day operations. The compensation model is known as 2 and 20. GPs charge around 2% annually in management fees to run the fund. On top of that, they earn 20% of the profits, known as carried interest, if investments succeed. This model aligns incentives. GPs are rewarded for delivering big wins, while LPs hope to generate returns well above traditional asset classes. It's a partnership designed around risk, patience, and outsized outcomes. VCs are inundated with pitches, but they consistently evaluate startups against a few critical criteria. First is the team. Investors bet on people as much as ideas. They want exceptional founders with deep domain expertise, proven execution skills, and strong founder market fit. A great team can pivot, a weak team cannot. Second is the market. VCs look for large, growing, and attractive total addressable markets, TAMs. A startup needs room to scale. Investors want to see the potential for billions in revenue, not just millions. Third is product market fit. Startups must show that customers actually want what they're building. Early traction, revenue, or strong user engagement signals that the product solves a real problem. Fourth is a scalable business model. It's not enough to have happy customers. You must demonstrate a path to profitable scaling. VCs look for models that can expand rapidly with high margins. Finally, there must be clear exit potential. Investors need to see a realistic path to IPO or acquisition. They are not interested in lifestyle businesses. They are looking for companies that can return the entire fund. In short, VCs look for great people, massive markets, proven traction, scalable economics, and big exit potential. Without these, even the best ideas struggle to get funded. The history of venture capital is filled with legendary bets that defined industries. Take Sequoia Capital and Airbnb. When Airbnb was pitching, many doubted the idea of strangers staying in one another's homes. Sequoia saw potential and invested early. The IPO validated their conviction, delivering enormous returns and proving the sharing economy model. Or consider Andreessen Horowitz and Coinbase. Betting on crypto in its early days seemed risky, even fringe, but A16Z saw the potential in infrastructure for digital currencies. When Coinbase went public, the fund returned billions, cementing Andreessen Horowitz as a leader in the crypto space. But here's the reality. For every Airbnb or Coinbase, there are dozens of startups that fail. Venture capital is governed by the power law, the idea that a few massive winners drive the majority of returns, while most investments fail completely. In fact, around 90% of startups fail, and VCs expect this. But they also expect a few winners to return 10 times or more. On average, just 3 successful companies can return an entire fund. The lesson is clear. VC is not about safe bets. It's about finding the rare outliers that can change industries and deliver transformative returns. Venture capital is a high stakes, high reward system that powers the startup ecosystem. It matters because it accelerates growth, brings networks and credibility, and creates the unicorns that dominate modern industries. It works by pooling money from limited partners, deploying it into startups through general partners, and harvesting returns through exits. VCs look for exceptional teams, massive markets, product market fit, scalable models, and exit opportunities. The stories of Sequoia and Airbnb, A16Z and Coinbase remind us of the power and the risk of venture capital. The reality is that most startups fail, but the few that succeed generate returns large enough to justify the risk. For founders, the takeaway is this: if you want to raise venture capital, you must understand the game you're playing. You must know what motivates investors, how funds operate, and what criteria drive decisions. Venture capital isn't free money, it's a partnership with expectations. Mastering its mechanics is not just helpful, it's essential if you want to scale your company into something truly world changing.